Today, property now. The DFA Daily to the 28th of November 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. In today's show, we look at more fallout from the Financial Services Royal Commission, approvals from the ACCC for NAB to buy Citi's Australian Consumer Bank, more on building defects, and the latest thoughts from SQM on property prices. But first, ASIC has commenced proceedings in the Federal Court against Australia and New Zealand Banking Group Limited, ANZ, for breaches of the Credit Act arising from referrals through its home loan introducer program and from unlicensed individuals outside the introducer program. The program involved home loan referrals to ANZ from third-party introducers from various professions such as cleaners and real estate representatives. Introducer programs received considerable criticism in the Financial Services Royal Commission. In fact, the introducer programs allow individuals or entities to enter an agreement with ANZ that allows them to refer customers looking for a home loan to the bank. The introducer receives a commission if the home loan is granted. Last year, a penalty of $50 million was imposed on the National Australia Bank for contravening national consumer credit protection laws in connection with its introducer program. moneysmart.gov.au has information about home loans and how to work with brokers to get a better home loan deal. ASIC alleges that between June 2016 and March 2018, ANZ breached consumer protection credit laws by accepting customer information and documents from introducers and other unlicensed individuals when this was not allowed. ASIC also alleges that some of the documents provided were fraudulent. ASIC Deputy Chair Sarah Court said ASIC is concerned that as a result of this conduct, some loans may have been granted by ANZ based on false information and some consumers may have entered into home loans that are beyond their ability to pay. If banks are going to accept referrals to consumers seeking a home loan from unlicensed individuals who receive commission payments for the referrals, they need to make sure they have the right systems in place to properly process those referrals. From 2015 to June 2020, more than 50,000 loans were referred to ANZ through the introducer program, resulting in lending of more than $18.5 billion. In September 2018, the introducer program contributed around 10% of all home loans sold by ANZ's branch network in Australia. ASIC also alleged that between November 2015 and June 2020, ANZ breached its general conduct obligations as an Australian credit licence holder by failing to take responsible steps to ensure its representatives did not conduct business with unlicensed third parties and thereby failed to engage in credit activities efficiently, honestly and fairly. ASIC is seeking declarations, pecuniary penalties and other orders, including for ANZ to engage an independent expert to conduct a review of ANZ's existing home loan customer referral arrangements. The proceedings will be listed for direction on a date to be determined by the court. Now, elsewhere, the ACCC has decided the $1.2 billion purchase of Citigroup's Australian consumer business will not dampen competition among local banks. NAB declared its intention to buy Citi's Australian Consumer Bank in August, with a deal including Citi's $7.9 billion home loan portfolio, which covers around 1.4 million customers, $4.3 billion of unsecured lending business operating under the Citigroup brand, as well as white label partner brands, $9 billion of retail deposit business, and its private wealth management business. On Thursday, the ACCC ruled the transaction will not substantially lessen competition in the banking sector after its review found no concerns from the group's overlapping areas, including credit cards and home loans. The watchdog said Citi is a substantial provider of credit cards and credit card services in the local market, which pushes the competition review to focus on the segment. Following the deal, NAB would become the dominant white label credit card supplier to a number of commercial partners and compete with them in the consumer-facing market. The ACCC has consulted with stakeholders including credit card suppliers, third-party distributors of Citi's white label credit cards, known as white label partners, and consumer groups, and few concerns had been raised. The regulator concluded that NAB would continue to face competition in the credit card scene, and it would be unlikely to have an incentive to offer less favourable terms to white label partners, such as small banks, with the aim of propelling its own NAB-branded cards. It noted scale is important in credit card operations, such that issuers have strong motives to have a large consumer base, including white-label consumers, over which to spread the significant fixed costs of investment of an issuing platform. And secondly, the regulator stated if NAB caused white-label partners' offerings to become less competitive or exit the market altogether, many consumers would switch to non-NAB credit cards, making such a strategy unprofitable for the group. And finally, the banks, who are white-label partners, may also have the ability to invest in their own credit card issuing platforms, although at a cost, of course, which could limit or remove their reliance on NAB's white-label credit card post-acquisition. ACCC Chair Rod Sims commented credit cards have continued to be an important product, despite increasing use of alternatives such as buy now, pay later. However, market feedback suggests that Citi is not unique with respect to its credit card offering, and many different credit card providers remain for consumers. NAB today is smaller in credit cards than its major rivals, and we don't consider adding Citi's card operations to NAB will materially change the level of competition. Citi has also entered the buy now, pay later segment with the launch of its product Spot in October. And also the ACCC review found NAB's acquisition was unlikely to raise competition concerns in any other areas of overlap, which includes home and personal loans, wealth management and investment products, and transaction and saving accounts. We're very concerned to ensure that mergers in the financial industry do not limit the competitive constraint provided by providers outside of the major four banks. However, in this case, the ACCC did not consider there would be a substantial impact in any market, Sims said. Now, next, given the pressure to turn on the migration taps, it's worth thinking about structural issues in recently built high-rise property. Research released back in October by the Strata Community Association of New South Wales found that nearly 4 in 10 new apartment buildings in New South Wales had serious defects. In fact, a New South Wales parliamentary inquiry also found that building defects were widespread. David Chandler, the New South Wales Building Commissioner, said, "They're not good numbers, and we had to really take that back to the industry and say, well, here's the evidence in reality. So if you want to accept the dial, you have to accept this reality. There's been really no accountability for people who managed to avoid their responsibilities." Kogan said our major cities have been transformed by the high-rise apartment boom over the past decade. And the chairman of Opal Towers Owners Corporation said Sydney is going up, it's not going out, and more people are going to be moving into apartments. But as demand for apartment living surged, major cracks began to surface in the state's building standards. David Shoebridge said what our inquiry found was that we need to reverse this deregulation. We need to stop this trend towards privatisation of the oversight of the building industry. What we've noticed, particularly in the last 5 years, is the effect of that is now being felt in a wave of defects across particularly the multi-level apartment industry. The high-rise debacle is the result of the failure of policy, which deregulated the building industry and eliminated the need for qualified inspectors to ensure these structures were built correctly. And the situation was made worse by 15 years of hyper-immigration pre-COVID, which required building tens of thousands of extra homes every single year, thus leading to speed over quality and compromised building standards. The situation needs to be urgently fixed, given the Urban Task Force projects that half of Sydney residents will live in apartments by 2057. Highly relevant given the drive for greater migration ahead. And SQM Research has released its Boom and Bust report for 2022, which tips slow property price growth next year nationally, albeit with significant variations across capital cities. The price falls will be led by Sydney and Melbourne houses, for which SQM Research is currently recording significant overvaluation. These cities are the most sensitive to even minor intervention by the banking regulator, APRA, in terms of home loan lending. In both Sydney and Melbourne, 2022 should see a turnaround in the unit rental markets, they said, and unit price growth should outperform that of houses, with houses being overvalued. Apartments are relatively affordable and are expected to be in greater demand from an expected rise in net migration from interstate and overseas, with Australia's borders now open. Louis Christopher, Managing Director of SQM, said, as 2021 draws to a close, the national housing market is starting to show signs of a peak. Auction clearance rates have fallen from their highs amid record listings. However, we may also be recording some seasonality and pent-up selling from vendors holding off after listings during the lockdown. Nevertheless, we expect the market to peak in 2022, with further expected intervention by APRA, which could come as early as next month, halting the price momentum. If the Australian housing market does not slow down by mid-2022, APRA will likely keep intervening in home lending until the market does slow down. We cannot afford another year of 20% plus gains across the national housing market, and so, to ensure a soft landing for the market, it is best we see additional interventions sooner rather than later to rein in property valuations. Other forecasts from Christopher's Home Boom and Bust report include dwelling prices in regional Australia to correct, particularly for inland communities as people return to the cities. Official interest rates are likely to stay on hold until at least late 2022. Further APRA intervention to occur as early as December 2021, and expected dwelling price corrections to be moderate and less exacerbated by aggressive monetary policy action involving rate rises later in the year, and ongoing rental rises for capital cities over and above the CPI change. Now, you can join a live show with Lou Christopher on DFA next Monday evening at 4:30 Sydney time, where we'll be discussing some of his research. And it's a live session. You'll be able to ask a question via the YouTube live chat. And note, this is an additional live show. I'll still be running my normal Tuesday show with Damien Klassen from Nucleus Wealth and Walk the World Fund at 8 p.m. Again, that's on Tuesday. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.